Hey, welcome back. Today we're talking about how do you make money in real estate? One of my favorite topics. All right, everybody's probably heard that 80% of the world's millionaires have made or hold their money in real estate. But why is that? Well, today we're going to take a deep dive into all of the different ways that I know of that you and I, as real estate investors, along with our investor partners, can make money from a real estate deal. And here's the beautiful thing. It's not just one or two or three ways. There are actually 8 different ways that you can make money in a real estate deal. Let's take a look right now. All right, the first profit center in a real estate deal, or potential profit center, is something called instant equity. What is instant equity? That's when you get a deal on a property, when you're able to buy that property for less than what it's actually worth. Now, you might have heard that the money in real estate is made when you buy the property. Well, this is what that's referring to. It's all about getting a really good deal on a property. So let's say, for example, we're looking at a $400,000 property. Let's say that the real world value of that property is $400,000, but you're able to find a motivated seller and negotiate and purchase that property for $350,000. That $50,000 is instant equity. Why? Because the true value of the property is $400,000. You paid $350,000 for it. If you turned around and sold it tomorrow, you would make $50,000 profit. Now, people always say, well, why would anybody ever sell their property at such a steep discount? Well, here's the thing. People go through life situations. People become motivated sellers. A death in the family, a divorce, a job, having to move across the country for a job, having challenges with the property. There's all sorts of different reasons people are motivated to sell quickly and not wait around to try to get top dollar. Plus, if you're doing a direct deal with the seller, they don't have to pay for a realtor's commission either. So there's all sorts of different reasons why somebody might give you the opportunity to create some instant equity. I'll give you an example of how this could work. So years ago, when I was doing creative deals, I came across a property. It was a little mobile home in a mobile home park, and the seller was asking $20,000 for that property. Now, I wasn't really interested in it, but she was very, very, very motivated. So we went back and forth, and I ended up purchasing that property for $5,000. I then turned around, sold it creatively for $30,000. So I was able to create basically $25,000 in profit from that property. Now you might be thinking, well, Dave, if she was asking $20,000 for it, why did she sell it to you for $5,000? Well, lots of different reasons. Personal reasons, there were financial reasons. Every single month that that property was sitting there vacant, she had to pay hundreds and hundreds and hundreds of dollars to the mobile home park for the pad fees, insurance, all of these ongoing fees and expenses that went along with the property, and she really just wanted to get rid of it. It had been sitting vacant on the market for a number of months, and the longer it sat on the market, the more motivated she became. The other reason was I really didn't want that property, and I was very upfront with her. I just told her, hey, I really don't want this, and the only way I'll take it that it makes sense for me is at this lowball, insulting price. And I don't blame you if you don't take it. And she tried to negotiate a little bit. I just wasn't interested in the property. So that's how I ended up buying it. All right. So yes, deals can be had, and it's all about finding motivated sellers. And at the end of the day, did I help her out? Yes, I helped her get on with her life. She got a pop of cash. She stopped losing money on this property, and she just got it out of her mindset. So it was kind of a win-win situation there. All right, profit center number 2, cash flow, cash flow, cash flow. You might have heard cash flow is king, but what does that really mean? Well, cash flow, the way I explain it to my prospective investors who are not active real estate investors themselves, cash flow is the money that's left over at the end of the month after we receive all of the rents and we pay out all of the expenses like our mortgage, property taxes, insurance, maintenance, all that kind of stuff. So whatever's left over is, as an acquaintance of mine calls, the jingle in your jeans at the end of the month. That is your cash flow. That is your net profit at the end of every single month. Another way of looking at this is your visible cash on cash return on your investment. So this is what a lot of people are into real estate investing for, is to create this passive income and that's what cash flow is all about. Third profit center is mortgage paydown. So every single month that your tenant is paying the rent and you're paying the mortgage, the amount you owe on that loan, on that mortgage, is going down gradually over time. Now here's the beautiful thing. At the end of the day, it's not really you paying the mortgage, it's your tenant paying your mortgage for you. So this is a beautiful thing about real estate investing, is that your asset gets paid for by your tenant over time. And if you hold on to it long enough, sooner or later, you're going to end up with a free and clear property and your cash flow is going to skyrocket. So mortgage paydown is a huge, huge, huge profit center, especially the longer that you hold on to that property. It's just not something that you're going to see in your pocket right away. You have to wait until you either sell the property or you refinance the property to really appreciate that mortgage paydown. Fourth profit center is forced appreciation. So what is forced appreciation? This is where you make improvements on the property and you increase the value of that property. So we're all familiar with this from the flip this house, flip that house type TV show, where people go in, find a crappy property, fix it up and sell it for a nice profit. That is forced appreciation. Now there's ways to do this with other kinds of properties as well. So for example, multifamily properties, you might not do the same level of renovations on a property, but the more that you increase the revenue and the lower you make the expenses, the more profitable you make that property, and that automatically increases the value of it a heck of a lot, actually. So forced depreciation is where you're taking control and pushing up the value of the property due to your efforts. All right, the fifth one is just normal market appreciation. And this is what we see and we're accustomed to with especially single family homes, is generally speaking, over time, the value of properties goes up. Now it dips, there's cycles to the real estate market. Sometimes it's up, sometimes it dips down, but generally speaking, in 90+% of the markets, over time, it just keeps going up and up and up and up. So this is one of the things that people get involved in real estate for, is because they can see the value of their property increasing and their return on their investment just going up exponentially compared to what they paid for that property. Now, challenge with appreciation is we've got zero control over that, and it is variable. So if you're in the market, if you're speculating on properties just based on speculation, that can bite you in the butt when either the market cycle goes down, interest rates go up, those kind of things. That can be very, very dangerous. So ideally, don't put all of your eggs in that one profit center. All right, the sixth profit center in a real estate deal is depreciation. Now, this isn't really a put money in your pocket kind of profit center. It's more of a tax deferral strategy, right? Because depreciation is the government saying, hey, you know what? The structure that you have on the land, over time, that's going to wear out and it's going to need fixing, it's going to need repairing, it's going to need replacing. So they allow us to claim the depreciation, the lowering of the value of that property over time off of our taxes. So that sounds great. That saves us some taxes in the short term. However, it can turn around and bite us a little bit upon sale of the property, because if you sell the property and it probably hasn't gone down in value, chances are it's gone back in value, it's gone up in value, then what the government's given, the government takes away in the way of recapture. So this is something that you have to discuss with your accountant. You have to be very aware of how it's going to affect your exit strategy. But for a lot of people, especially high net worth individuals, so that might be you or some of your investor partners, taking depreciation can make a lot of sense. All right, profit center number 7 is leverage, one of my favorite profit centers in real estate. And what is leverage? This means that you and I, maybe together with an investor or joint venture partner, we can purchase a property with a small down payment instead of having to pay for the whole thing in cash. We're able to get the bank to finance the purchase of this property. And banks love good real estate deals. So how does this work? Well, let's say, for example, we're purchasing a $500,000 property, just for easy numbers. So $500,000. If we're purchasing this as an investment property, there's a good chance the bank is going to look for 20 to 25% as a down payment. So let's just say it's a 20% down payment type deal. So that means that yourself or you with your investor partner or just your investor partner, somebody has to come up with $100,000 and the bank is going to chip in the other $400,000 and finance the property for us. Now, what's the big benefit about leverage and financing the property? Well, let's say that $500,000 property over the next few years increases in value by 10%. So 3, 4, 5 years down the road, now that $500,000 property is worth $550,000. Well, that's great. That's a 10% increase in value. Let's say that's over 3 years on that $500,000 property. But here's the cool thing. Your return on investment is actually much higher because you're getting $50,000 increase in value on your $100,000 investment. So instead of that being a 10% ROI for you, this is actually a 50% return on investment for you because you've used the bank's money, you've used leverage. So this is one of the reasons that so many people love real estate compared to stocks, bonds, mutual funds, crypto, pretty much anything else out there, is because the bank loves to finance this particular investment. It's much more difficult to get financing for other kinds of investments. If you want to buy $500,000 worth of gold, guess how much it's going to cost you? 500 grand. That's right. The bank's not going to finance you on that. If you want to buy $500,000 worth of stocks, typically you're going to have to pay $500,000 for those, right? Now, you might be able to get some financing or shorting or doing this kind of stuff. Pretty risky though, so you have to be careful there. So one of the reasons we all love real estate is because we can get leverage, because we get financing on the property. Last but not least, the last profit center in real estate is something we call reinvestment. What is that? That is when you take your profits for one deal and instead of blowing them on a nice new car or a boat or a vacation or something like that, you recycle those profits into another property. So for example, that example we used of the $500,000 property that went up in value by 50 grand over the next few years. Well, if we refinance that and we pulled out $100,000 in equity, let's say, and we went out and we bought another property, then basically we're using the first property to purchase the second property, and it can start to snowball over time. So reinvestment is a great way to grow your money. Now, speaking of growing, if you're interested in growing and scaling your portfolio sooner rather than later, then eventually you're going to have to look at other people's money, bringing on investors or bringing on joint venture partners. If that's the case, I've got a really good resource for you. Now, I'm a little bit biased because I wrote it, but it's my book, Money Partner Formula. In this, I walk through my entire process of attracting your ideal investor partners and raising 6 figures in a matter of weeks and even 7 figures in a matter of months, even if you're starting from scratch. Now, not only has this worked wonders for myself, but it's worked wonders for literally thousands of other real estate investors just like you. So go ahead, get your free copy today. I'll trade it to you for your name and your email address. Just go to investorattractionbook.com or scroll down in the description below and click on the link that's down there. Take care. Talk to you soon.